Thank you. Hello and welcome to Activating Magic. I'm your host, Darla Ledoux. I'm here with Michael Hession.
Hey, how are you?
Great. This is the second only episode recorded in person, so I'm glad you're here. And if you're listening in your audio, go check it out on YouTube and you can see us live, which is more fun. Thanks for being here.
Cool. Good to be here.
So Michael is the founder of The Perfect Asset, and he helps entrepreneurs build lasting financial security by transforming debt into wealth. Like, we have to get into that for sure. Using specific low risk and proven whole life insurance policies that help place you in the driver's seat with your finances. So his job is to help you transform from being a victim to financial systems that don't have your best interests at heart into someone with the tools and knowledge necessary to build the wealth you and your family deserve. So I know about this because we've talked about it. And I have, when I talked with you about the work that you do, was the third time I had heard of this.
That's
and
right.
so
Yeah,
I think, third time's a charm, like the good things come in threes. So I'm like, oh, this is really interesting. So first of all, before we dive into what you do, like just give a little bit of your background and what brought you to this work.
Yeah, it's important. It does inform things. So I mean, just from a business sort of standpoint, entrepreneurial standpoint, I started my first business a couple of years out of college. So I was 24. Didn't know what I wanted to do. And then my father was a business broker, and he came across a business that was, it was a canvas shop, like a custom boat canvas shop the guy was trying to sell. And I had done a lot of sailing, and I like to work with my hands. And he was like, hey, maybe, we could do this. So we worked it out, and I had that business. I ran it for 16 years, ran it alone. My dad was partnered with me for a while. Then he passed away a few years into it. But I kept doing it, just got really good at it. Didn't really turn into a legit business, really, and I burned out after 16 years. So I got to experience being a small business owner who didn't set it up right as a business to pass on, and I had no exit strategy, so I just burned out. So
Wow, 16 years is a
16
long
years,
time, though.
it is. It's a long time. And
So you were paying yourself, but you
Yeah.
weren't building wealth.
Exactly, and I didn't know anything about any. I was just like a lot of business owners. They get good at what they do, and they just money they do make goes back into the business. And the idea of having something set aside is just they don't even almost like have not time to think about it.
I totally know
And I
how
was
that
way.
is.
Yeah, right. So that's part of it. And then but before I shut that down in 2005, Annie and I, my wife, we bought our first home in 2002, and it was a two-family. So just going through that process of having a tenant contributing to the mortgage and being in really investors, and I started reading Rich Dad's books and just getting into that world. In 2006, I learned how to trade in the markets. There was a company teaching people how to be self-directed traders in options and futures and currencies, and I did that. I was doing pretty well leading into. So that kind of was like, and then my business, I just mothballed it and walked away from it. We had the rental property. We were going to build our real estate empire.
2006, you said,
well,
it started?
2008. So we had the two-family. We sold it at a nice $100,000 profit, but we had to do a tax exchange because we didn't live in it long enough to just keep the money. So, but we turned that into a 6-unit, and everything was fine. 2006, 2007. Annie had lost her job, which was a high-paying job in 2007, so then 2008 happened, and things started really going bad. Became almost impossible to trade in the markets. The neighborhood where our 6-unit was kind of, things went bad. It got bad. There was mostly rentals, houses getting boarded up, going into foreclosure.
Right.
She started an online business, and I really discovered our foundation was not solid. And we had a lot of debt, which was all tied to the property pretty much, and a little bit to my trading account. I couldn't save ourselves with my trading. Things got crazy. When you're trading in the markets and things get volatile and go bad, it's like a whipsaw. So it was just like confluence, and were deep in debt, and we ended up going into bankruptcy. We chose that option in 2008. It was discharged in September of 2008. And it was a long climb coming out of that, I think especially for me. My wife was much quicker at like crawling out of that hole than I was. 'Cause
Like emotionally?
yeah,
Yeah.
I was suicidal. I think if had I been had somebody tested me for clinical depression, I'm sure I would have been like, oh yeah. And I didn't talk to anybody
Yeah.
about it. But I would entertain thoughts of it's not funny, but it's I share this because it informs who I am today and why I do what I do. We had some term life insurance at the time. I didn't know anything other than it was $250,000 if I passed away for a 20-year period. Anne would get that. And I started to, in my head, go, well, maybe she'd be better off with that money than me. And, didn't do anything about it, but it was roiling around in
Wow,
my head,
yeah.
And obviously didn't do anything about it. And just a long, slow climb out of that. I hadn't worked for anybody in 20 years. So now I'm 45. I'm like, hey, what do I do now? Didn't want to I dabbled in trading again. We came across a little bit of money, and it just my heart wasn't in it. That's a real zero-sum game. If one person's on the winning side and the other's on the losing side,
Yeah.
and usually the house wins. Like just like in Vegas,
Right.
Wall Street or the big banks
Right.
usually win because they get information before everyone else does. So all these things informed me. Then eventually, I even though didn't want to trade again, learning about the market was really interesting because there's this flow of money that just that's just going back and forth. This money flowing back and forth in currencies and everything. And if you can tap into that somehow, or access it, or leverage it for yourself, I was interested in it. So and my wife's suggestion, I started looking into getting employment with a financial company. So I went to a job interview for a life insurance policy, a life insurance company, and I thought that could be because it's kind of in the financial space, but it's not directly in the market. And it was there that I learned about just the benefits of whole life insurance that I had no idea about. And then about a year into that, I learned about this thing called infinite banking, using
Yeah.
a very particular type of whole life. So it was all these things that sort of informed me.
Interesting.
Yeah, and I just see, as a lot of these institutions, they're not bad people, Wall Street, government, big banks, they sort of do what they do, and they're sort of about self-perpetuation and keeping things going because they have a pretty
Sure.
good gig.
Right.
It's nice, and if you're not part of that, then you sort of have to figure it out for yourself or find someone who can sort of guide you.
Right.
So I see myself as that guide.
I love it. Well, I'm going to ask more about that in a minute.
Yep.
I'm curious because you had such an intense journey around money. Were there anything in your early days, like your childhood, that gave you messages about money? Or did you have was that a theme for you or your family when you were younger?
I wouldn't, not that per se, but it was interesting. I seen what my father went through as he worked his way up the corporate ladder. He'd been in the military. Once he got out, he got into the defense industry on the management side of things. So seeing him as I grew up, he worked his way up the ladder, like VP and stuff. And eventually, he became the president of a small firm. I grew up in Maryland, and he got this job offer to go to this firm in Florida. I had 1 year of high school left. They said, hey, we don't have to take it. We'll stay here in the DC area, and he can remain a VP, or we can take it. And I thought about it. I said, Dad, let's go ahead and go. And then he became president, and I just saw what it did to him, the pressure. So he'd gotten up the ladder. He was making more money than ever. We had a house with a pool, and they bought a sailboat, and he was so stressed out. And I think he died at 63. And I know
Yeah.
that pressure and his health kind of led to that. And then I was like, oh, okay. And then I saw his former workmates in the DC area come down, and as things went bad for that company, after a couple of years of him being down there, they just came down and fired a bunch of people. And in my mind, I was like, okay, making money meant you had to screw someone over. That was sort of my,
Right.
of seeing that firsthand, like seeing him work so hard, get to the top, and then he didn't screw people over, but he got screwed over, You
So
know, and
he was one of the people they fired.
yeah, well, they gave him leave of absence, and then eventually they blackballed him. They weren't going to rehire him. He was, in his late 50s, didn't really want to take a pay cut.
Yeah.
So it just seemed, to me, it was. I started to equate making money as being a bad thing.
Yeah.
That
I
you
can
had
see
to, and
that.
I didn't want to screw people over. It wasn't in my nature. So it wasn't magic so much. It was more, and it took a while to let that go. That notion that if it takes.
How did you let it go? I mean, I'm assuming you
Yeah.
still don't want to screw people over.
No, but even there's still residuals of it, I think, at
Yeah.
times that I have to sort of identify and go, okay, no, if I'm doing really well, the people that I'm helping, they're doing exponentially better than I. You know what I'm saying? Like my income rising means that I'm helping more and more people out, and
Right.
what they're getting and their families are getting now and in the future for future generations, because this is an intergenerational thing because of the nature of what it is,
Right.
life insurance, and it's so yeah, it's probably we did a lot of landmark education stuff, and that helped.
Yeah,
You
I've
know?
also done
Yeah,
landmarks. So
yeah. And then Annie going through the process, she had a real money block a few years, and she sort of cleaned it up, and I saw, those are the results.
like, oh, I can do that.
Yeah, and seeing it actually works, and
It's
so
amazing.
no,
So let's talk a little bit about how you help people.
okay,
So infinite banking, I heard about it from a friend
Mm-hmm.
who had someone probably like you kind of sit him down and tell him like you can be your own bank and you can do all these things, and
Yep.
he relayed it to me, so I had it third hand. And then like a couple of years later, I was at a conference where there was a speaker about it, and he laid out all the math, and I took it home and I like poured over it. And I'm like, oh, I mean, this really makes sense. And then I met you, and you
Right.
have shared about it. So, when we think about magic and we think about money, like most people listening have some kind of block about money.
yeah,
Some wherever they are, whether they're making millions or they're just making their first sales, like there's always a limit that or there's often a limit that we place on ourselves, like this is my money ceiling. So what is infinite banking, and how can it help someone break through that?
okay, yeah. It can involve a lot. It can seem like a lot sometimes when people try to explain it at a sort of a high level. I think the way to think about it, and I'll back up real quick. It's called infinite banking because this gentleman Nelson Nash sort of reintroduced the world, to the U.S. at least, and Canada, to these very long-standing whole life insurance policies that have been around for close to 200 years, and that have been utilized by people for that long, and they were just kind of forgotten about by the general public. In the last, I'd say, 50 years, starting in the 1970s, it was very common for my grandparents to run a lot of their money through whole life insurance. It was very common back in the mid 50s and last century in the U.S. And it just, everything kind of got shifted towards the market and 401ks and IRAs and all that kind of thing, which for the industry was good because it puts the risk on their clients. If their money's in something like the stock market, they don't have to do anything. They're just
Right.
like, I'll put you in a fund and we'll hope for the best and I'll earn my
Right.
fees.
Right.
And so for them, it was great. And they can make more money. The first company I worked for, they really encouraged me to get my securities license, which is what allows me to hold assets under management. And I can take people's money and stick it in a fund and earn fees.
Right.
Yay, that's fun. It never appealed to me. So Nelson he wrote this book called Becoming Your Own Banker, and it was really, he wanted people, it was geared towards financial professionals primarily. He said, look, you should be teaching, you should learn about this, that life insurance is not just for safety, it's so much more than that, and you should be teaching it to your clients. So that was really his desire. He called it infinite banking because it puts the banking equation on your side, which no one thinks about, right? That's what the
Yeah.
banks do. You just make your money and you store your money in the bank and then do other things with it.
Right. So I'm going to ask more, but whole life, and you mentioned term life insurance
Yeah.
before. Like, do you want to say a couple words about what the difference is? I'm assuming
Yes.
term is probably the thing that I have that I bought from my State Farm agent. If I die, someone gets money.
Yeah, and term is very common. It's for a period of time. It has no cash value, so there's no cash component. You can't bank out of it. It's strictly protection, and it's there. Part of the thing is this started back in the 1970s or so. This company called Primerica, which is backed by Citibank, they were really good at saying they came up with this phrase: buy term and invest the rest. So they actually said it's better to buy term insurance, which is cheap, and then
Put the
take
other
your money
money
and
in
invest
the
it in
stock
something else,
market.
like with us.
Right.
In their case, right?
Right.
They're like, so they aggressively got people out of these wonderful whole life insurance contracts and convinced them that they should not do that anymore. Buy cheap term and invest it, which is great for Primerica and other,
Right. So it was
stock related
good
companies.
marketing.
Great marketing. They were very good at it, and it's dishonest, and you can sort of manipulate and make it sound good. So so term is very specific period of time, and most term doesn't even pay out. So what happens a lot is people will buy, like the term insurance that we bought was 20-year term, and we bought it shortly after our second daughter was born. The idea being that there's protection for when we're raising
Until
them,
she's
right?
20,
To cover the mortgage and stuff like that. A lot of companies will do what's called renewable term for their employees, strictly protection. Whole life is a completely different thing. As long as the premiums are paid, the premiums don't change, and you have it for forever.
And you actually can access that money.
Especially
That's
when
the
you set up the
difference.
right way, you can access a good portion of that money early on for whatever you need. And you mentioned before the turning debt into wealth. That's one of the strategies that you can implement
Yeah.
with it. Yeah.
Awesome. So I want to, I'm thinking about the people listening. They may be kind of where you were in your business that you had for 16 years and maybe not building wealth. Just getting by, reinvesting back in the business, thinking it will grow in the future. And so what would you say to someone who's in that place about what you'd recommend with their money?
I think one of the key things is to not be afraid to learn about it. I think partly with all these structures like banking and 401ks, it tends to be when it comes to your money, you hand it off to someone else, especially when you start making some money. There's professionals that will manage it
Sure.
and that, right? And then it's not something you deal with. And then so
Right.
there's sort of a built-in misunderstanding about it. And we certainly don't teach us about it in school.
Right.
It just isn't. It's not even on the curriculum.
Right. And I remember, I worked at Procter and Gamble and they had the fund all set up and they did profit share or, matching donations and donations, purchases.
Yeah, contributions,
Yeah. And so I'm sure whoever had that fund, right, that gig was doing really well.
Oh yeah, they love stuff, especially for companies, because a lot of those bigger companies, they have to provide 401ks. So it's sort of like a built-in, hey, it's great for us. So
Yeah.
and they're not a bad thing. It's just that.
And they ask you, what's your risk tolerance and when do you want to retire? And that's it.
Yep.
And that's the only
Yeah.
input that you really have into where your money is going.
Yeah, I feel so bad for people right now when the market's been tanking. If you're coming on retirement now and are ready to where you can pull out, you may have lost 20% of the value that it was a month ago or so.
Right.
That's the problem when you have those things,
Right.
because you have no control over it whatsoever.
And so how is the whole life and the infinite banking different?
These whole life insurance companies that I use and that infinite banking practitioners use are what are called mutual life insurance companies. They're not publicly traded, they're private, so they don't have a share price. So they don't lose value. So like you heard about Elon Musk, like Tesla, losing all this value because they're publicly traded and it's all a lot of their value is tied to the stock price.
Right.
These companies, that's not the case. They're mutually owned, so the policy owners actually own part of the mutual life insurance companies. So they're in a they're a different asset class, and they have guarantees inside these contracts. What's called the cash value grows no matter what. It's guaranteed, and it's not affected by the stock market fluctuations.
And is it a smaller percentage?
Yeah, well, typically it's like
But
4%.
it's guaranteed.
It's guaranteed, and
Yeah.
it grows tax. It's net of taxes.
Okay.
So
So
401ks.
yeah, talk more about that.
Yes, so that's the thing people forget about. Your 401ks, not only you have very limited access to those funds, it's taxable at some point. And so and the way they sell it is, oh, well, your tax bracket should be, smaller when you're 65 and ready to retire. Like, who wants to have they'd rather be in a higher tax bracket, right?
Right.
When you're 65. So that's how they count. They taught me to do the same thing. And they're like, well, then it'll be less of a burden when they force you to withdraw.
So this is
and
also
pay
marketing,
tax.
it sounds
It's
like.
great marketing. And
Propaganda.
it probably started out well-intentioned, but then it just becomes, because it's Wall Street. This bank, if anybody's interested, there's a great book called The Pirates of Manhattan. It's a fantastic book, and it shows you how over time, again, these aren't bad people, just as institutions, these banks started getting, like after 2008, they got a little more power, like the big banks. The money inside your savings and checking accounts at banks aren't as safe as you might think. FDIC insured. Things, just don't like pull all your money out of your savings account, but they're not nearly as safe as you think. And it's all kind of geared towards benefiting them. So these contracts, these life insurance contracts, they operate differently, and they have those guarantees. The net of taxes is the IRS treats the premiums that go into these things as having already been taxed. So it's an IRS designation, whereas money going into a 401k, they're saying it's not been taxed yet.
Right.
So they function differently.
And so in 2008, 2009, people who had these funds, did they lose anything?
Nope. As long as they could keep paying the premiums, they didn't lose a cent.
Okay.
They're contractually guaranteed to not lose. They keep
Okay.
getting bigger, and over time,
So there's not a point where the fund would go, oh, never mind, we're in a recession.
No, because
Just
their
kidding.
whole life, and the companies that I use, the other piece is, so there's a guaranteed part inside the cash value. It's whatever's in the cash value component is what you can access, the funds. So that usually grows around 4% guaranteed. On top of that, these are what are called participating whole life insurance companies, which just means that when they're profitable, they share the profits with the policy owners. The dividends are never guaranteed, but the companies that I use and been paying dividends every year for 150, 175 years.
Even in 08, 09.
Even in the Depression, even
Yeah.
in Civil War. So these companies have a track record. And in that Pirates of the Manhattan book, a point that I just read it a couple months ago, these companies, these mutual life insurance companies, are some of the best money managers on the planet. So once you understand that, and you find out that big banks like Bank of America hold billions of dollars of life insurance in these mutual life insurance companies, because they're not stupid. They keep their safe money in life insurance. They buy life insurance on all their key people. So you're like, maybe we should do something like that. If the banks know that keeping their cash, billions of dollars of cash in life insurance in these life insurance companies, it might be something worthwhile for us to do as well. So think of it, instead of put as much money really as you can, once you understand it a bit more and have lots of education, instead of just sitting in a savings account earning next to nothing, that you have almost no control over. It's pretty safe, but you don't have any control over it. Instead of running through these life insurance policies, you get a death benefit, things unexpected happens. That's guaranteed to be a payout and protection for your loved ones, your business partners, whatever. But the whole time you can access it and start to
Use
operate
it like a bank.
Yeah, and operate like a banker. And becoming your own banker is what Nelson called that book, because it's when you put the banking equation, you take what's an open-ended economy for a lot of people, where money comes in and money goes out. People say it all the time. Oh, I had it and then it's kind of gone. And you're always trying to make more money. And the problem is we're not keeping enough of what we're making.
Right.
Our savings rates have gone way down, partly because the savings environment are usually not very good. They're banks, which give you next to nothing.
Right.
These things give you a lot.
Right.
So part of it, my job is to educate people on the value of just keeping as much of your money as you can in a different environment that's much better for you.
So, can you give an example of, well, actually, I have another question first. Why do you think, so if these are the smartest guys in banking doing the whole life or in finance, money management, why are they not trying to rip people off like other places?
I think
Is it a value system thing?
I do.
I don't know if you know, but I'm
do.
curious.
I think it is.
Why
'Cause
don't they go to Wall Street or whatever?
I've met people in these companies, and I think because of the nature of it, because it is life insurance, and that I know that my clients, it's like an ongoing relationship. It's very much a relationship thing. So as things change, we look at it and go, okay, well, what can we do? Whereas I think a lot of on the sort of stock market side of things, I think it's very transactional. You know, give me your money, I'll stick it in a fund, we'll review once a year, maybe make some tweaks to it. I'm not saying they're all bad, because like my wife's had a financial advisor who did really right by her family. And he used whole life insurance from one of these big Mass Mutual,
okay.
as a big component of it.
Okay.
You know, they also had stuff in the market, but
So do you think they attract people who are more relationship driven?
I do.
Okay.
And I think because of the nature of it. And then, you know, I haven't had to do it, but at some point I'll have a client pass away on me and I'll have to deliver a check, you know, to a bereaved family. So I think the nature of it is different than, and I think these companies, they just operate differently. There's an integrity about them.
Yeah.
That I see, because they couldn't succeed and be profitable if they didn't do it right.
Right.
And some mutual life insurance companies have done what they call a demutualization. They chase the money. They decide to go in and become publicly traded. And that's their right, but it's just a different thing.
Okay.
Now it's the shareholders who matter.
Right.
You know, and that's where you get
Right.
it, like laying people off can help a share price. So.
Right.
So by their nature, by that not being a thing, I do think there's a certain integrity and a certain values, you know.
You know, I'm thinking about, we talk about magic here, right?
Yes.
And I'm thinking how you found this values aligned work. Like it feels like it really fits with who you are.
Very much so, yeah. And in fact, when I was with this other company first called Bankers Life, and they're okay, big, you know, life insurance company, nothing wrong with them, but I couldn't do these whole life insurance because they're not a participating mutual life insurance company.
Okay.
They're publicly traded. They don't have the same kind of whole life policies that these companies do. And once I learned about that, I quit like a few days later because I saw the value in this and what it could provide for people. And if I can't do that with you guys, because I was a captive agent, which means I couldn't do anything else. And I said, okay, this doesn't work for me.
Yeah.
So it very much was. And it's funny, the magic part, I was thinking about this because you mentioned this the other day or yesterday. To me, it's once you can, because we know money is energy, right? And it can be the biggest problem for a lot of relationship things, the lack of, the stress of it. And if you can get that piece of it handled, where you have more control over it, more say over it, and more of a belief that it's not going to lose. Like, I have no concerns. We have 9 policies between my wife, myself, and our kids. I don't worry about it. I know they're always growing and getting bigger and larger and are not affected by this.
Yeah.
So
Where so many people are stressed right now.
Oh my God, I really feel for them. And it'll probably come back. I don't know.
Right.
Again, so there's that component of where it's, and there's a peace of mind around it, which if you have peace of mind, then you can sort of not worry and stress about that so much. So it's a big deal to me.
So let's do some practical examples. So when you all started, I think you said you started with paying some debt.
Yes.
So how did that work? rather than paying the debt, you bought the policy. So talk about that.
Yeah, it's a great story. So,
And if we were live with an audience, I'd be like, raise your hand if you want to pay some debt.
right, yeah, and so it was. We had it was my wife Ann's father had passed, and part of his estate was being released, and we had $24,000 coming to us. This is 2014 thereabouts. So we're still inside that 10 years. There's a 10-year period when you go through bankruptcy where your credit's really bad. So we're still inside of that.
Yeah.
You know, we're like halfway, right?
Yeah.
That was 2000. We're a little further, we're a little closer to 2018 where it was finally off the records and our credit could, you know, so we had a lot of debt still. And you might go, okay, well, we could take that we had about $20,000 of high interest credit cards that we just had accumulated, upper 28%. But I'd learned about this whole life insurance. We still have those term insurance policies. They hadn't quite run out yet. But I learned enough to say, okay, and the guy I first learned about, I said, what could we do with this? He said, well, let's do this. Take the $24,000 and do a whole life policy. 20 of it is what they call a first year dump in, and it goes right into the cash value. Whatever's in the cash value is what you can tap into. 4 of it is the ongoing, what they call base premium. So we did a policy on Annie because she's healthier and female, and we just figured it made sense. And it was her father's money. So we did that, and we took what you do when you access the cash value, you take a loan out against it. Why do you do that? Because then the principal keeps growing at that 4%.
Yeah, that's
regardless.
The part that's magic about it, right?
Yes. Because
you can use the money and still earn interest.
Yes,
on it.
and you're dwelling in the area where people like Warren Buffett and other people they borrow when they need capital. They don't tap into the principal. Ideally, they borrow against it and then put it to work elsewhere. So we're kind of doing the same thing. Yeah, because you don't pull it out of there, you take a loan from the life insurance company based on what's available. We paid off that high interest credit card debt.
How long from when you put the 24 in was it till you took
1 month, 4 weeks.
4 weeks?
Yeah.
And then you took the 20.
We took a loan out from the company, paid off that high interest credit card debt. Now, why is that better? Well, we could have just used cash to pay it off.
Right.
So we would have paid off the credit cards,
And then
we could jack those up again, right?
Right.
Back up to 28%.
Right.
And do the cycle, which I think a lot of people do.
Yeah.
So pay down, jack it up, pay down.
Yeah.
We call it working back to zero.
Right.
We want to stop working back to zero. So what we did instead was we paid that off, and then we start to act like a banker. And instead of paying Visa, we paid back to the life insurance company. It gets reapplied to our cash value, and then we do it again. So it just, you don't tap into the principal.
And it's growing 4%.
It's
the
growing.
Whole time.
And then I've started to say before, the dividends that these companies declare also add to the growth of it. So over time, like we're talking 10, 12, 15 years, these things, the cash value starts to compound. And the internal growth of these things actually will blow away the stock market returns down the road. We're talking like 15, 20 years because there's constant compounding in these things.
If you don't take it out.
Yeah, idea is you never take it out. You take loans out when you need it. So that's how you turn debt into wealth, and that's where you operate like a banker. And I have clients do this. They'll say, "Look, you're paying $500 a month for a car to GMAC financing or whatever.
Right.
If you have like money sitting in savings, let's put it to work. But set the asset up first, then tap into it to pay off the debt, and then you are now the lender
that
for
was
yourself."
going to be my next thing because we talked about this.
Yeah.
I have a car loan.
Oh, that's right. Yeah.
And savings, right? And we
Yep.
talked about, okay, you do it. I was thinking, should I pay my car off? Right? No, don't pay the car off.
Not without setting up the asset first.
Right.
If you can.
Right. So let's talk about that. So if the loan balance is X and I'm putting that in, like, how would that work? Basically the same as.
Oh, I mean, if you
debt.
set up a policy first,
Yeah.
you do the same exact thing.
Yeah.
Yeah. So what we would do is I think I mentioned that we have a very powerful analysis tool that people can put in. A lot of my clients will do it. They'll just put their information in because I view myself as kind of like a surgeon with what I've learned and what I know, really, and I have to see, what do you have and what makes the most sense. And there's nothing private, but just your numbers. So it's your credit card. What's the rate? What do you pay?
Yeah.
Do you overpay? If so, what is that? And then I can come up with a couple scenarios. And if it was like a car and that was the most obvious thing to go after, if money's sitting idly in savings, that's like low-hanging fruit to me.
Right.
Let's put it to work. Because sitting in the savings account earning
Earning
0.2,
nothing, yeah.
even on a high yield savings account, which can approach like 4 or 5%, you're paying taxes on those. That's not net of taxes.
Right.
Inside the policy, it's net of taxes.
Right.
So we were just, and then if we can do a dump in to start with, we just say, you pay off the vehicle loan. And here's the thing, you don't have to pay the loans back to the life insurance company, ever. They're unstructured loans. It works best if you do, because then you're replenishing it and then you can use it again. So in Nelson's book, I highly recommend, if anybody is into Becoming Your Own Banker by Nelson Nash, it's sort of the Bible of IBC. And he talks about it. Once you start it, it's best if you operate like an honest banker for yourself. And as best you can. And you don't have to. The company never puts you on a payment plan.
Because it's your money, really, right?
It's your money, and the reason they do it is if the person were to pass away and there were outstanding loans, they simply subtract it from the death benefit. So that's it. So for them, it's a very safe loan because they're on the hook for a death benefit in some future year.
Right.
Whatever, $500,000, $1 million. If someone has a $200,000 outstanding
And
loan
there's
balance,
never a term where it expires.
it never expires, as long as the
it.
premiums are paid.
Yeah.
So
Okay. Oh, and what are the premiums?
it depends. Everybody's different.
Okay.
Premiums are what keep so any life
Basically
insurance.
what I'm paying now
Yes,
to State Farm.
Yeah, but really, I like to think of it when these whole life insurance policies set up the right way, with as much cash value as possible. It's really like you're making deposits. Instead of depositing your money in a bank, just think of these as depositing into your policies instead.
Got it.
That's really what you're doing.
Okay. Is there any downside?
I mean, sometimes if they are doing a larger policy and they take a loan out early on and never pay it back and then let the policy lapse, they could be taxed on that.
Okay.
Yeah.
So
in other words,
it.
here's an example. Say if someone's doing like 100,000, and I've
makes
heard
sense.
of this happening on higher end like investor types, who they get a little too fancy for their own britches, to use an old phrase. They might say they do like $100,000 total premium, and let's say, I don't know, 20,000 of it is the base premium or what's called the principal, and 80 of it goes into the cash value. They take a loan out of almost all 80 of it, and then never pay it back, and then change their mind and don't want to pay the premium next year. The IRS says, hey, you only paid 20 in
You're
principal
basically
and you took a
stealing at
loan
that
out.
point.
So that's like, you owe taxes on that difference.
Right.
Does that make sense?
Yeah.
Yeah. So
But they don't owe the insurance company?
no, it would just lapse. It would go away.
Huh.
No, they wouldn't. Because it was their,
It was
technically
their
it was
money.
their money, yeah.
I get it.
It'd be more of an
Okay.
IRS thing.
Interesting.
Yeah. It would make the from the agent or producer side of things. I've talked to people who there's a red flag. The way they're talking, I'm like, I don't
feel
really.
the
Let's shake hands and go,
integrity
part company, because you're trying to be too cute. This is at its foundation is a savings and liquidity strategy that you can do a lot of great things with it. That's good, huh? So,
I like it.
yeah,
So what I'm guessing integrity is one of your core values.
it is.
Yeah.
It is. Yeah.
I hear that.
It is. So if you wanted to do something fancy, there are these things called IULs or Index Universal Life policies that they're out there, and they look kind of the same. They're not. They don't have the guarantees, and there are a lot of agents pushing them. Could they make more commission than I do, or the whole life that I do?
Right.
Beware. If you hear about it and you start, researching this stuff, head for the hills or talk to someone like myself, because there's a reason that those are being pushed, because they're not the same thing. They look similar,
Marketing
but they're
again.
not this. Yeah, exactly. The market, they can make them look really
Taking
super
advantage
fancy.
of this.
Yeah, and they
trend.
have ties to the market, so some people they can't help themselves. I got to be in the market. Got to be in the market. You
Right.
don't. I know people who have been using these whole life contracts and they never even invest in anything. They become lenders. Become like banks actually, and they'll.
Right.
But rather than
Lend
taking
to other people.
yeah,
Interesting.
and they'll take policy loans out of their policies
Right.
and loan it out,
Right.
and then have them pay it back in, and then they pay it back, and the
Right.
cycle and repeat.
Interesting.
Yeah, and when you take loans out, the company never asks you what it's for. It's your money, I just say,
Right.
hey, I need $20,000.
You don't
Okay,
have to
we'll
go
send you a check.
prove
No, you don't
anything.
have to. But it's important because it is life insurance. So the pre-qualification stuff is your health, your ability
Right.
to pay for it. So you do have to get, they're fully underwritten.
Right.
So I do have people sometimes where they will be declined, and or an offer will not be made, and the company will say we're not willing to take on the risk, given
Okay.
like health considerations or stuff. So
Okay.
so that can be the
So get in early.
yeah. But sometimes you can, if it's a couple, say, okay, maybe you're not healthy enough, just do it on the spouse, or look at doing
Right.
it on the spouse, or business partner, or
Got
children,
it. And
or
you help
grandchildren.
people figure all that out.
Yeah. So
Yeah.
but from the life insurance, it has to be some reason that you're paying for a policy. They call it
Mm-hmm.
insurable interest. But grandparents who might be in their 90s can own and pay for policies on their grandchildren.
Okay.
And they might be, uninsurable, but they can
Right.
still own it, and it can benefit the other generations.
Right.
So there's a lot of
Interesting.
flexibility, because people tend to think whole life is very rigid. It's really not. It's much
It's-
less than you would think.
When you're talking about it, the thing that I am finding in this conversation is like you're making it sound fun, like a game.
It is fun. It's so
like,
fun.
like playing a game.
And a lot of
with
what
your
I do,
money.
I'll do is when I talk to people, I'll find like, what are their goals? Like, what are you up to? What do you want to do in a few years from now? Because that's, I think, one of the things that Nelson was brilliant. And the reason he called it infinite was that once you take the banking function and control of it as much as possible, what you do with it, the possibilities are infinite.
Yeah.
I have clients who have, there's a famous story of Walt Disney. Back in the 50s, he had whole life, like a lot of people did back then. He had his film studio and he wanted to do his first theme park. And the banks were like, go screw.
Right.
We're not lending
You're
you
gonna
anymore.
do what?
And then he was like, oh, wait a minute, I have 100,000, I think it was 100,000 in his cash value. Called the company and they sent him a check. It wouldn't have been electronic back then, and helped to fund his first thing. So I had a client do a similar kind of thing where he had a business opportunity, he had enough cash value. The banks were like, nope, we're not going to do anymore. And he was like, hey, can I just, yep. And he needed it quickly. So we expedited it and
Yeah.
got it like 2 days later, closed the deal. And
Nice.
yeah, so there's turning debt into wealth, buying businesses. I have, real estate, building
Yeah.
their own real estate empire, but getting it into these safe liquid asset
Yeah.
first and then doing these other. Another thing is that these are called the and assets, these whole life insurance contracts, because you can do them and you can do real estate. You can do this and you can turn debt into wealth.
Right.
You can do this and you can invest in the stock market if you want
You
to.
basically can use the money twice.
Yes, it's like using the same dollars over and over again.
Interesting.
Yeah.
I love it.
Yeah.
So if people want to talk with you about their situation and see if this is right for them, what's that look like?
Yeah, you could book a call with me and
And we'll put that in the show notes,
yeah,
the
yeah,
call.
yeah, and I would definitely get Nelson's book. My website, michaelrhession.com, is still up and running, and just learn more about it because it's a different way of thinking and looking at things, and it's so worth it.
But if they get on the phone with you,
Yeah.
like what could they expect?
Well, we'll have a conversation and just to sort of see. I'll have some recommendations. I have some great training videos that I'll suggest that you watch, and it's because it's
But they could come and they could say, look, I have this, and
Yeah.
I have this, and I have this.
yeah.
Is this
I
right
would
for
probably
me?
like find out your goals like in that
Yeah.
first conversation because something would have triggered you to have you call me, and it's our goal, like my goal, having come through. I'm an authorized practitioner through the Nelson Nash Institute, and Nelson's goal was to have enough people doing this for themselves so that the banks and Wall Street would have to maybe, okay, we'll give you 3% on your savings
Right.
account. Like
Right.
because right now they can do whatever they want because they really run
Right.
the world.
Because
when it
we are so conditioned that that's the only option.
Exactly, yeah. And we get
Yeah.
busy and we're, it's understandable.
Yeah.
And it gets, kind of, and my fellow professionals are partly guilty too. And no real fault of them. If they came up and all they learned was that you have to become, a financial advisor who handles money. That's all you would, and life insurance is just for protection. So you throw it in as an afterthought.
Yeah.
Whereas no, you're going ass backwards. Excuse my French. You want to do these things first, and then build out
Yeah.
and do the. Oh, here's another thing. And a lot of times people they'll be dwelling in these areas and not have like Andy and I. Our foundation was not strong enough. Really, looking back on it, where I should have been trading in the markets, even though I did pretty well, and it wasn't a lot of money. but we did, like, to get the 6 unit, we did refinance. It was that's back when they did those no income verification things. So we were sort of dwelling in these areas that we really
Right.
had no business
Right.
being in. So when things went sideways, we got wiped out.
Right.
So the idea is that get that foundation solid, so then you can start building. And then when things go sideways, you're not affected by it.
Yeah.
And when you're not affected by it, getting wiped out, when opportunities come, you can take advantage of them. Because it's the flip side of it. It's not just savings to squirrel away your money for retirement. It's also savings so you can take advantage of opportunities when they come up. And they do. When you're set up right, you're at peace. I love the idea of being at
Right.
peace.
Right.
Then you're like, oh, that's an opportunity. Let's look
Right.
into that.
And you might not even see that
Yeah,
if
if
you were
you're stressed out and you're like, it doesn't occur as that.
Yeah.
I'm getting little shivers now. That's the
Yeah.
magic. Whenever I feel like something, I get these tingles up and down my
Yes.
spine. I just got that. So
You've got some woo in there after
there is,
all.
yeah. I think I got probably going through bankruptcy and stuff. It sort of got like, but it's coming back.
Yeah.
It's back. So
Yeah, that's beautiful.
I'm happy to help. It's so important, and it's just, and it takes some doing. You have to be willing to do some work. But if you think about anything that's worthwhile, it's a process and takes some effort. There's nothing given to you, unfortunately. You have to spend
learn
some time.
this,
You
but
have to learn it. And I'm here I'm partnered with a firm called Factum Financial, and there's so many resources ongoing because this is an ongoing thing,
Yeah. Well, it seems way more fun to manage what loans am I taking from myself rather than what's my login for my credit card so I can pay my bill or right?
Yeah, exactly. And it can be fun. It really can
Yeah.
be. I think people get scared by numbers too. I mean, I didn't like math when I was a kid. I was horrible at math. And it just that I'm doing something kind of sort of related to math is sort of a shock to me. But it's really not about that. It's about the relationships and just putting people in a better position.
Awesome. Thank you. Thank you for
welcome.
being here and for
My
coming
pleasure.
in person. Any parting words you have for people?
No, just reach out. I'm happy to help, and don't be afraid of finances and that kind of thing. It's better to have a hand in it and be paying attention to it, and it doesn't take that much time, and it's worth it.
Yeah. Thank you.
You're welcome.
Thanks everyone for listening. We'll give you Michael's calendar link in the show notes, and we'll see you in the next episode.